Welcome everybody. I am Ganesh Narvade, and in this video we are going to revise income from other sources. Very less time, but every point will be discussed in this video. So stay connected, and notes are given in the description. So you can take the benefit of the notes also. Okay, chal, let's start discussion. First thing, what is income from other sources? देखो, if any income is not taxed under salary, house property, PGBP, capital gain, that means if it is not taxed under the first four heads, then the income is taxed under income from other sources. So we can say it is residuary head of income. Right, section 56, 57, 58, 59, only four sections are there in this chapter. Okay, so what we discussed, any income which is not taxed under the first four heads is taxed under this head, that is income from other sources. It is a residuary head. Now there are some incomes which are absolutely taxable under this head, like example dividend. A company gives a part of the profits to shareholder, that's dividend. It's taxed under income from other sources. Irrespective of anything, it's taxed here only. Right, casual incomes like winning from lottery, crossword puzzle, betting, gambling, right, betting on horse races, all these type of incomes are called as casual incomes, and that is taxable under income from other sources. Right, gifts, suppose you get any gift, that is taxable under income from other sources. Suppose you get it from your employer, taxed under salary. If you get it in relation to your business or profession, then it is taxed under business and profession chapter. Otherwise than that, if you receive any gift, taxed under income from other sources. Now, suppose example, government compulsorily acquires your property. Then government will pay you some compensation. Now, if the government delays in paying the compensation, government not only pays that compensation, but also pays you interest on it. That compensation is taxed under capital gains chapter, but the interest on it is taxed under income from other sources. Right, now, if suppose example you entered into a contract and the other party defaulted, the other party paid you the advance, but later on he was not able to pay the balance amount, so you forfeited the advance. For you, it is income from other sources. Like example, you are selling the property, you took some token amount as advance, right? Like that, cases are covered here. So what did we learn? Certain incomes are absolutely taxable here. What are they? Dividend income is absolutely taxable here, right? Casual incomes like winning from lottery, betting on horse races, gambling, right? It's taxed here. Then we discussed about something called as gifts, like if it is from employer, taxed under salary. If it is in relation to business and profession, taxed under PGP. But if it is other than that, it is taxable under income from other sources. That's gift, right? Then we discuss interest on enhanced compensation or initial compensation, advances forfeited if there is a breach of contract by the other party, right? These are items which are taxed under income from other sources. Let's continue that there are certain incomes, if they are not taxed under PGVP chapter, then they are taxed under this chapter. Like suppose example, employees contribution to provident fund, that is first treated as income under PGEP. But if it is not treated as income under PGEP, it will be treated as income under the head other sources. Okay, this way you should remember. Later on, if the provident fund amount is deposited by the company, the employee's share is deposited with the provident fund trust, then definitely deduction can be claimed. But first, it is treated as income. If it is treated as income under PGP, great. Otherwise, under other sources, it can be treated. Okay. Then we have to understand that plant and machinery renting of plant and machinery is there. Composite rent is there. Right. These type of rents are taxed under income from other sources. Right. Interest on securities is there. It is taxed under income from other sources, if not taxed under PGBP. Then please remember, certain incomes, if they are not taxed under PGBP or salary, is taxed here, like keyman insurance policy. If the policy premium is paid by employer, then later on, if the policy matures, who will get the money? Is it employee? Then tax it under salary. If it is the businessman, the employer, then tax it under PGP chapter. But if the maturity amount is received by any other person, then such scheme and insurance policy amount is taxed under income from other sources. Then suppose example terms of employment are changed, or suppose employment contract is terminated, then it should generally be taxed under salary chapter, right? For a normal employee. If it is for a business head, under PGEP chapter, like Cyrus Mistry, example, I'll give in the class, correct? Then, if it is not a normal employee, if it is not a business head, then it may be an agency, right? It may be some freelancer who is having some specialized skills, right? In that case, if terms are changed or modified or cancelled, then definitely the compensation paid for that is taxed under income from other sources. Like this, you have to understand what are that items taxed here. Now let's continue. That I'll tell you lot of list. I said if any income is not taxed under the four heads, then it will be taxed under other sources. It's given in section 56, subsection 1. But can I give some examples? Shall we discuss? Are you ready? Yes. Suppose example, teacher corrects the papers of employer's college, then it is taxed under salary. But if teacher corrects the paper for university, which is not employer, right? Then it is taxed under income from other sources. Suppose he goes for invigilation at some other place, then it is taxed under income from other sources. Or if the teacher goes for Viva at some other college, it is taxed under income from other sources. Private tuition he takes, income from other sources. Student actually goes for practical training and gets stipend, taxed under income from other sources. Suppose if property, house property is given on rent by the owner, then it is taxed under salary. But if the tenant sublets it, sorry, if the house property is given on rent by the owner, it is taxed under income from house property. Yes, this is right. It is taxed under income from house property. But if the tenant again lets it, we call it as subletting. Subletting of house property is taxed under income from other sources. Because the tenant is not the owner, na? So house property section 22 conditions are not satisfied. Okay, then shall we continue with the discussion? If vacant land is given on rent, then it is taxed under income from other sources. Suppose if you receive any interest on savings bank deposit, recurring bank account deposit or fixed deposit, right? If you receive interest on income tax refund, right? If you receive interest on provident fund account, or if you receive any insurance commission like LIC policy, you sell, so you get insurance commission. All these are taxed under income from other sources. Suppose you are a director at a meeting, attending the meetings, so you get director's fees. Or suppose some undisclosed cash or assets are found or income is found by the income tax department. That income is also taxed under income from other sources, right? You have to understand dividend from cooperative society, that is also taxed under income from other sources. Please remember family pension. Dekho, employee gets pension is taxed under salary. But if it is family pension, then it is taxed under income from other sources. This way you are supposed to remember the topics. Now I'll tell you one more thing. Suppose winning from lottery is taxed under other sources under section 56 subsection 2. But if suppose the persons who are actually maintaining, owning and maintaining the horse races, for them it is business. That owning and maintaining horse race business is not taxed under PGEP, but taxed under income from other sources as business income. It's taxed under income from other sources as business income. So like this, you have to understand. Right. So we understood this. Now, the method of accounting is very important for you. Right. If suppose you actually compute income under PGBP head or other sources head, if you follow cash basis in your accounting records, then income tax also you will compute income under cash basis. Suppose you follow accrual basis, then under income tax also you have to compute income under accrual basis. So whatever method of accounting you follow, whether it is cash or accrual, You follow whatever in accounting, same is followed under income tax only for two heads. What are they? PGBP and other sources. Right. Now we have to discuss about casual income, that is winnings from lottery. Like example, somebody is winning from lottery or from betting and gambling or from crossword puzzles or from card games or from betting on horse races, maybe participating in TV shows, game shows, uh, card games and winning something. These type of incomes, 5 items, are treated as casual incomes. And on these casual incomes, 30% rate of tax is applicable. How much? Come on, repeat with me. 30%. Okay. Can they deduct expenditure related to these winnings? The answer is no. No expenditure related to these winnings can be claimed as deductions. But don't get confused, right? If suppose any jockey is there, horse rider basically, right? That jockey earns some income, it is his professional income. Or suppose motor vehicle rallies are there, right? That rallies require certain skills. So that's why these motor vehicle rallies or jockey's income is not casual income. It's just normal income, taxed normally. Okay, this difference you should be able to understand. Now, can you claim any deductions from these casual incomes? The answer is no. Deductions are not allowed. Then what rate it is taxed? 30%. Okay. Suppose example, if you earn income, the whoever actually pays you the money should deduct the TDS. So suppose example, you won a lottery of 1 lakh rupees. You will not get 1 lakh rupees. You will get only 70,000 rupees. Why? Because tax is 30% on it and TDS under section 194B, 194BB, 194BA, these similar sections are there on winnings from online games, winnings from something like casual incomes or horse races. For these three sections are there. Rules are same. What the rule says? Simple. 30% TDS should be deducted. So you won 1 lakh rupees, but you will get only 70,000 rupees. Now in the question, they gave you that amount received on winnings from lottery 70,000. So you cannot write 70,000 in your income. You have to write 70,000 into 100 by 70. Right? How we got 70? 100 minus 30 is 70. This way you will consider your income to be 1 lakh rupees. Okay? This is how you should understand each and every topic. 1 lakh into 100 by 70. That's it. 70,000 into 100 by 70. Right? Then you will get the 1 lakh rupees. So grossing up is required. Suppose in the question they gave gross amount. Then don't do anything as such. Directly take in the solution, right? But if they give net amount or if they simply say amount received, then definitely you have to gross up by multiplying the amount given into 100 by 70. 100 by 70 is only for winnings from lottery or casual income type incomes. Okay. Suppose example, your winnings is less than 10,000 or up to 10,000. Don't deduct TDS. Okay. So if suppose they give winning from lottery received 5,000, then take directly 5,000 because TDS not applicable here. Okay. Suppose it is winning from some camel races. There is no TDS applicable. So directly take the amount. Okay. This is how you are supposed to remember the topics. Now come to renting of plant and machinery. Generally, in today's time, what happened? Laptops are given on rent, fridge is given on rent, washing machine, cot, what not, everything is given on rent. So renting is a business. If it is business, let it be taxed under income from business and profession. So renting of plant and machinery, if it is business, let it be taxed there. Suppose some business is continuing business, but for some temporary period they are on halt. They will continue their business after some time. During this period, they give property on rent, right? I'm talking only about plant and machinery. Okay. Then such renting is treated as income from business and profession. But other than these cases, if any renting of plant and machinery or furniture is there, let it be taxed under income from other sources. Suppose example, house property is there and plant and machinery furniture is there. If they are given on rent at collectively, we call it as composite rent. If rent of house property is separable and rent of plant and machinery is separable, then house property rent is taxed under house property chapter, rent of plant and machinery taxed under income from other sources. But if example not separable, then rent of house property, rent of plant and machinery not separable, then combined rent, composite rent is taxed under income from other sources. This you should be able to remember. Now, related repair expenses are there, related insurance expenses may be there, related depreciation may be there, or suppose to purchase the plant and machinery, you took some loan, you are paying interest. These type of expenditures can be claimed as deduction for computing the net income. So what are the expenses I said? Current repairs, insurance premium, depreciation, interest on loan to purchase the plant and machinery, right? These are deductible. Okay, this you should be able to remember. Now, let us continue about family pension. What is family pension? Come on. Suppose if the employee receives, it is taxed under salary. It is normal pension. But if employee dies and their family members receive the pension, it is family pension. Now, generally family pension is taxable because it is received monthly, it is taxable. Then they give some exemption to it. How much? The answer is least of the following two. 1/3 of the family pension or specified amount, whichever is lower. What I said, 1/3 of the family pension or specified amount, whichever is lower is allowed as deduction. Now, what is that specified amount? If you are filing return under default tax regime, it is 25,000. If you are filing return under old tax regime, it is 15,000. Come on, repeat with me. What is the exemption? 1/3 of the family pension or specified amount. What is specified amount? Under default tax regime, it is how much? 25,000. Under optional tax regime, how much it is? Or I can say under old regime, how much it is? 15,000. This you deduct. Then from the family pension, if you deduct least of the following two, you will get the taxable family pension. Suppose example, a government employee is there or any employee. He died and because of death, the gratuity became due, leave encashment became due. Then legal heirs receiving the gratuity, leave encashment is not taxable. And sometimes the central government or state government gives some gratuitous amount, ex gratia amount at the time of death of the employees. Right? If they give ex gratia amount, that is also fully exempt. It is not taxable as family pension. Like this, we should understand the topic. Now we'll discuss about gift. I already said to you that if suppose employer gives gift, taxed under salary chapter. If suppose in relation to your business, your supplier, your customer gives gift, then it is taxed under income from business and profession. All other gifts taxable under income from other sources. Suppose example, you may get gifts of cash or movable property or immovable property. Only these three types of gifts generally people get. Suppose example, you get a cash gift. Cash gift, if it is more than 50,000 rupees in a year from all the people together. Now come on, repeat with me what I said. Cash gift in a year from all the people together more than 50,000, then entire amount is taxable. Suppose you got 60,000 rupees, complete 60,000 is taxable. You got 40,000 rupees, it is less than 50, right? So it is not taxable. So you should remember, once it crosses 50, entire total amount becomes taxable. Now, movable property. Now, movable property you may get without consideration or with inadequate consideration. Without consideration means there is no consideration at all. In that case, if the fair market value of the asset is more than 50,000 rupees, what I said, if the fair market value of the assets more than 50,000 rupees, then such movable property gift is taxable, right? But here also, that aggregate in a year from all the people together is very important, right? If the fair market value of all the gifts together in a year exceeds 50,000, then entire amount or entire fair market value is taxable. Now come to the inadequate consideration part. Suppose example, we talk about movable property. Movable property may be jewelry, it may be bullion, correct? Right. So I'm talking about jewelry, archaeological collection, painting, drawing, right? This type of immovable property, you got it for inadequate consideration. That means less consideration. So what we'll see, fair market value, and compare that with consideration. Now we'll see what is the difference between the two, right? You are saying consideration is less. Now compare the fair market value with consideration and tell me what is the difference. Okay. If the difference is more than 50,000 rupees, then the entire difference is taxable. Suppose example, fair market value is 1,50,000, but consideration is just 40,000. Then what is the difference? 1,50,000 is the fair market value. 40,000 is consideration. Difference is 1,10,000. Is it more than 50,000? Yes. Then entire 1,10,000 is taxable. Okay. Suppose example, fair market value is 1,50,000 and consideration is 1,20,000. What is the difference between the two? 30,000. So it is less than 50 now, not taxable at all. Okay. This way you should be able to understand. But is it single gift? No, it is movable. So all gifts together in a year should be considered. Year means previous year. Okay. Now come to your immovable property part, land and building part. If it is without consideration, then the stamp duty value we should check. And if stamp duty value is more than 50,000, then entire stamp duty value is taxable. Okay. Suppose example, the value of the property is 2 lakhs. The stamp duty value of the property is 2 lakhs. Then it's more than 50,000, so fully taxable. Okay. That's it. 2 lakhs is fully taxable. But suppose example, if property is given for inadequate consideration, less consideration, in that case, what will happen? In that case, what happens is simply you have to check what is the stamp duty value, what is the consideration. The difference between the two, is it 50,000, more than 50,000 or not? If suppose it is more than 50,000, the difference between stamp duty value, sale consideration, more than 50,000. Then also check second point, that is stamp duty value greater than, more than 110% of sale consideration. Right? If it is the case, then definitely the difference between stamp duty value and sale consideration is taxable. But here what happens is, we will not check aggregate. We will check each immovable property transaction separately. Correct? Each immovable property transaction we will check separately. This way you are supposed to remember. Cash means obviously cash, banking channel, electronic mode, all that are covered. Now, if any income is taxed under income from other sources, then same it will not be taxed under capital gains. Correct? This you should be able to understand. Suppose you are not happy with the stamp duty value, then you have all options to challenge it and request the income tax officer to appoint a valuation officer, right? An income tax officer, if he feels fit, he'll appoint a valuation officer to consider. Okay. Now, what is property? Please understand. What is property? Property is very important word, because if it is movable property, immovable property, first it should be property, correct? Immovable is obviously only one or two, building, land. That's it. Okay. Movable means shares or securities, bullion, jewelry, archaeological collections, painting, drawing, sculptures, work of art, right? And last one is virtual digital asset. These come under the definition of property. Now, if suppose gift is given, generally it's taxable if you satisfy any of these conditions. But in some cases, even if you satisfy all these conditions, it is not taxable. What are that cases? Hum dil cart, HUF, ADD. What are that? H. If suppose a gift is given by hospital or medical institution, right? Right. If any gift is given to medical institution or hospital, if the gift is given to university, if the gift is given to, in the case of a marriage, if it is given in the to the hospital or medical institution, to a university, or in the case of marriage, or in relation to a death, or in relation to inheritance or will. Suppose father transferring property to children, right? Right. Or if the gift is given to a local authority, in that case, right? Cut. Charitable institution gives any gift to you, right? In that case, this gift is fully exempt. That if relatives give any gift to you, then it is exempt. If any private trust is created and the money is pumped into private trust for the benefit of some relative, then definitely it is also exempt, right? Now, if any HUF partition happens, HUF partition happens. So in that case also, if it is total partition or partial partition, the family members get some properties, correct, that are also fully exempt. And finally, you have to remember, if it is the case of amalgamation or in case of demerger, right, any assets are transferred, right, or in case of any disaster, central government gives any money to people for rehabilitation and all that, in that cases also it is not at all taxable. So you remember the keywords actually. What are that keywords? Come on, repeat with me. Sorry. Come on, yeah, repeat with me. Right? I want to talk to you. Chalo. First thing. Okay. Hospital or medical institution, university. In case of marriage, or I want to tell you that if it is in the case of death, inheritance, local authority, correct? Remember this. Charitable association, it may be trust, right? Which is giving some donations or some gifts, right? Relative giving you gift, or any private trust giving gift to the nominees, right? Whoever are going to become the beneficiaries, right? Then I want to talk to you about HUF, full, total, or partial partition, right? Amalgamation, demerger, in that case also. And finally, in case of disaster also, please remember, if central government, state government, local authority gives any money or any assets for rehabilitation, that is fully exempt, right? This way you are supposed to remember. Relative is very simple. Self spouse, self parents, mother and father, right? Then your self brother, sister, sister's husband, brother's wife, right? Spouse, their mother, her mother, or her father, right? And brother and sister, their spouses, and the children of self and spouse. All these come under the definition of relative. This you have to remember. In case of HUF, all the members of the family are relative. This is simple definition. Then we have to understand interest on enhanced compensation or initial compensation. Whatever interest received is fully taxable. From that, standard deduction 50% is allowed. Suppose you received interest of 80,000 rupees. 50% standard deduction, 80,000 into 50%, 40,000 will come. 80 minus 40, 40,000 is fully taxable interest on initial or enhanced compensation. This you remember, that's enough. Interest on securities we have to talk about. Interest on securities, what they say? Interest on securities means securities of central or state government, or any securities held by or of the local authority or of the company or of any corporation set up by state, central or provincial act. So only these securities interest we are talking about here. Now what is the tax treatment? Obviously it is taxable. How? Based on the method of accounting you follow, correct? If you follow cash basis, when it is received, it is taxable. If you follow accrual basis, then when it is due, it is taxable. Now, what is due? The interest is to be counted on due basis mostly. It don't accrue day to day basis. It accrues only on that particular day when it is due. Suppose you are the owner of the security on that day, then the entire interest is taxable to you. This is how the concept works. Okay, grossing up. Suppose example they gave interest amount received. So most of the cases it will be after TDS, because under section 193, 194A, TDS is deductible at the rate 10%. So then if they say interest received net, then you have to simply remember the interest amount into 100 by 90. If you do, you will get the gross interest. Suppose in the question they gave gross amount, then don't do anything. Okay. Now let's continue with the related expenditures. What are they? Repay. Okay. Interest, right? If it is interest, then what are the related expenditure? Only interest on loan taken to purchase the securities or any collection charges. These two are allowed as deduction, nothing else. This way, if you remember the topic, that's it. Now, let's discuss about deemed dividend. Now, what is dividend? You all know, right? Dividend is the amount received by the shareholder for his investment in proportion of his shareholding, correct? So basically, he may receive it in cash, kind, whether it is out of taxable income, exempt income, whether it is out of past profits, present profits, whether it may be out of capital receipts or revenue income, no problem at all, right? Ultimately, who pays? Company pays. To whom? To shareholder. For what? For return on his investment. That's it. Okay. Now come to the next point. In income tax, section 2 clause 22 talks about an inclusive definition of dividend. Now I'll tell you a simple story, right? Revision is there, but still I'll explain the concept. Don't worry. Company was to pay tax in the past on the dividend. To avoid the payment of taxes, they started giving some assets, giving some loans. This way, the companies try to escape the payment of dividend. So, government want to curtail this activity of the companies. They brought this type of section called as deemed dividend under section 2 clause 22. Now, will company give entire assets as a, gift to the employees or to the shareholders? Not at all, correct? So they will only give up to the amount of profits. And that's the central theme of this section, right? Anything, whatever we discuss, up to the amount of accumulated profits. That's what you are supposed to remember, right? Let's continue with the discussion. Now, first point, section 2 clause 22a. It talks about any distribution up to the amount of accumulated profits. Now, these may be general reserve, securities premium, right? Or it can be capitalized also, converted to capital also. Okay. So any distribution up to the amount of the accumulated profits, whether capitalized or not, which results in release of assets of the company. That means some assets are given to shareholders. Okay. It is deemed dividend. Now, please remember, suppose if company issues bonus shares, only liability side there is a change. Asset side there is no change. There is no release of assets. That's why issue of bonus shares is not deemed dividend. Now, when assets are released, what should be the value taken? The value for computing the deemed dividend should be the market value of the assets. Should we take book value or market value? Market value should be taken, not the book value. Right? Right. In case of amalgamation, the amalgamating company gives assets to amalgamated company. It is not deemed dividend. Okay? Please remember. Ultimately, they want to come together to make the business big. So that's why it's not deemed dividend, not tax. Okay. Now come to second point. Section 2 clause 22b. Any debentures are there, debenture stocks are there, deposit certificates are there. If they are issued actually, what I said, debenture stock, debenture certificate, deposit certificates are issued. Debenture stock, deposit certificates are issued. Till this point is clear. To whom? To equity or preference shareholders. Up to what amount? Up to the amount of accumulated profits, whether capitalized or not here again. Correct? So this is deemed dividend. But remember, if suppose, if preference shareholders are given any bonus shares, that is also deemed dividend. Okay? Generally, they are not supposed to be given any bonus shares, but if it is given, it is deemed dividend. This, if you remember, that's it. Now, come to the third point. Now, at the time of liquidation of the company, if any assets are released or given to shareholders, up to the amount of accumulated profits, whether capitalized or not, is treated as deemed dividend. But suppose example, preference shareholders are repaid. It is not deemed dividend. Okay? If preference shareholders are repaid, it is not deemed dividend. Right? Because ultimately it is a redeemable capital, correct? That's why. Okay. Suppose example, we are talking about at the time of liquidation. So any accumulated profits up to the date of liquidation, for that we'll treat it as deemed dividend. But suppose profits are earned after the date of liquidation and they are distributed, it is not deemed dividend. Okay. Now come to the fourth point. Section 2 clause 22D. If suppose there is a reduction of share capital. Now you all know reduction of share capital means what? Correct? Very good. So if there is a reduction of share capital, right? In that case, any distribution up to the amount of accumulated profits, whether it may be capitalized or not, is treated as deemed dividend. Right? Now come to the fifth point. If suppose any loan is given, that is section 2 clause 22E. If any loan is given or any advances are given, to whom? To the shareholder. Which shareholder? Not all shareholders. Only a shareholder who holds 10% of voting rights. Suppose example, Patanjali Ayurvedic Limited. Only two shareholders. Ramdev Baba, Acharya Balakrishna. Balakrishna ji holds 98% shares. So if Patanjali Ayurveda gives any loan to Acharya Balakrishna because he holds more than 10% voting rights, then in that case, remember that it is deemed dividend. Loan given to Acharya Balakrishna G is deemed dividend and taxable in his hand only. Suppose Acharya Balakrishna also holds 40% shares in Patanjali Foods. Now, Patanjali Ayurveda gives loan to Patanjali Foods. It is also deemed dividend, taxable in the hands of recipient, that is Patanjali Foods. Now, why I gave the example of Patanjali? Because when section 2 clause 22E is written, they said any company in which public is not substantially interested. So that's why I gave Patanjali's example. Because here public is not substantially interested. Right? If public holds 20% voting power, general public holds 20% shares, then it is public having substantial interest. But here it is not the case. So for such companies only, section 2 clause 22E applies. Are you able to understand? Okay. But suppose if the lender or if the company giving the loan is a banking company or it's a non-banking finance company, NBFC, then this 2 clause 22E deemed dividend not applies. Because for NBFCs or banks, giving loan is in the ordinary course of business. Or suppose the company is a trader in certain goods or wholesaler or manufacturer of goods. It is giving trade credit. That means they are selling goods on credit. This type of advance is not covered under section 2 clause 22E. Right? This way you have to understand the topic. Now, when we talk about 2 clause 22E, they also talk about up to the amount of accumulated profits. But they say that only up to the amount of accumulated profits. So it should not be capitalized. That's what they wanted to tell. So only the reserves and surplus part, up to the amount of reserves and surplus part covered here, not the share capital part. Okay, this you should clear. Suppose later on this loan is repaid. Will the dividend tax be ignored? The answer is no. Even if the loan is repaid, still the dividend tax is applicable. Okay. Suppose example, later on the company gave the dividend. They first gave the loan. It is treated as deemed dividend. Now they are giving dividend. In that case, the dividend is not taxable. Okay. That's how you have to remember. Now section 2 clause 22F. This is super important because it's an amendment. And this came from 1st October 2024. Why they brought it here, God knows. But it is here, so we have to learn. Now, let me tell you. Suppose example, in the past, if companies buy back the shares, so company will pay the tax in the name of income distribution tax under the chapter capital gain, and it was exempt in the hands of shareholders. Now, for your exam, this is important to learn, because if any buyback happens before 1st October 2024, whatever I said till now will apply. That means company will pay company will pay income distribution tax at the rate 20%. For shareholder, it is exempt. This will apply for our exams till 30th September 2024. For shareholder, it is exempt. For company, it is taxable under the head capital gains. Right, 20% is the rate of tax. Whatever company paid minus whatever they received from the shareholder, right? Indexation, all that is applicable, right? But from 1st October 2024, what happened? If company do any buyback, the rule is simple. It is deemed dividend taxable. Okay, whatever shareholder paid for purchasing the shares, can we deduct it? No. Whatever shareholder paid, it is not deductible, right? So company did buyback, company paid money to shareholder, that is taxable under section 2 clause 22F as deemed dividend. But whatever the shareholder paid to the company to purchase the shares, it is not deductible. Then what to do with that? The answer is, whatever shareholder paid, it is treated as a capital loss and can be adjusted from any capital gain. Okay, this is how we have to understand this. Okay, on this problems may be expected, so do practice some. Okay, let's continue with this. What we discussed, deemed dividend, right? Now, what is accumulated profits for this purpose? If suppose company is not into liquidation, we should check accumulated profits up to the date of distribution. If suppose company is going into liquidation, then accumulated profits up to liquidation. If suppose it is the case of section 2 clause 22E, that is company giving loan, then up to the date of giving the loan. So basically accumulated profits are reserves and surplus of the company. But reserves and surplus till what time should be checked? That's answered here. Not in liquidation, up to the date of distribution. Company into liquidation, up to the date of liquidation. Company giving loan under section 2 clause 22E, then up to the date of giving loan or advance. Now, who will pay tax on the dividends? Basically, the shareholder, the recipient will pay the tax. That's it, you should remember. Where is the place of accrual? It is Indian company. Then place of accrual obviously will be in India. If it is foreign company, then there are so many rules like DTA, double taxation avoidance agreement. Then we have to think about something called as place of effective management rules, right? So foreign company will presently ignore, right? In final, we'll discuss in detail. Let's continue with the next thing. What I wanted to tell you, that under section 57, any interest on loan paid to purchase such shares, right? Dividend is given generally on the shares only, na? Right? To earn such dividend income, that is deductible under section 57. But how much? If suppose you receive dividend of 1 lakh, interest can be deductible, that is actual interest, or 20% of the dividend, whichever is lower. So that means any interest on loan is deductible, but only up to 20% of the dividend amount. This also you should remember. Now, we understood about dividend in detail. Now, new section is introduced. Section 115BBJ. What it talks about actually? It talks about winnings from online game. What is online game? Using internet. If you use internet on computer or on phone, you play some game, right? That is online games. And any winnings from online game is fully taxable at the rate 30% plus surcharge if applicable, and health and education cess also. Then deductions under section 80C to 80U, that also cannot be claimed. Related expenses cannot be deducted. 80C to 80U cannot be deducted. And not even that, but the basic exemption limit, right? Suppose you only have one income, that is online winnings. So you will feel that if I am filing return under default tax regime, up to 3 lakhs basic exemption I want to enjoy. But that enjoyment also is not available. So suppose you don't have any income and you earned 2 lakhs rupees online winnings. You have to pay 30% tax plus health and education cess. Sir, up to 3 lakhs basic exemption not available. Forget about it. Okay. Now, section 58 talks about disallowances. That means, suppose example, you want to deduct personal expenses, income tax say not allowed, right? If you say I want to deduct income tax, wealth tax, right? Cess, fees, penalty under that, or any interest on loan taken to pay income tax. Income tax says not allowed. This is not deductible. Okay. If you say I have paid interest outside India, if you say I have paid salary outside India, right? If you say like this, then income tax will ask, did you deduct the TDS? And if the answer is no, they will ask, did you deposit the TDS? If you say no, if TDS is not deducted, if TDS is not deposited on interest or salaries paid outside India, then entire interest, entire salary not deductible. You have to remember. Suppose any payment you made to a resident on which TDS is deductible, any payment you made to a resident on which TDS is deductible. And if you don't deduct the TDS, you directly make the payment without deducting TDS, then 30% of such expenditure is disallowed. 30% of such expenditure is disallowed. Suppose 1 lakh is the payment, then 70,000 you claim deduction, but 30,000 no deduction allowed. Okay. Suppose later on you deduct the TDS and deposit it, then you can claim that 30 also. Okay. Remember like this. Now, any unreasonable payment to relative, not allowed. Suppose the payment to relative you should have made 40,000 as per the uh, principles of natural justice or ordinary course of business. 40,000 you should have made the payment, but you actually paid 70,000. Then this 30,000 cannot be deductible. This excess payment is not deductible. And one thing we discussed in PGBP, you remember? I said na, cash payment cannot be more than 10,000. But suppose any payment for a single transaction on a single day, you make payment in cash. It is 15,000, 20,000, 50,000. Entire cash payment is disallowed, right? And lastly, I want to tell you that if any expenditure in relation to winnings from lottery, crossword puzzles, right, betting, gambling, right, even if it is purchase price of the ticket or of the lottery entrance fees, nothing is deductible, right? Entire winnings is taxable in case of casual incomes. This way you are supposed to remember. Now, section 59, deemed profit. So earlier you actually claimed some expenditure as deduction, but later on you received that amount. Then section 59 says it is taxable. Section 59 says it is a taxable income. Okay. Now you say that I am not the person who claimed the deduction. My father claimed it. Okay. Even in case of succession, even in case of inheritance, earlier the deduction was claimed. Earlier you claimed it as loss. Earlier you claimed it as expenditure. Earlier you claimed it as allowance. Right? And you reduced your income. But now you got that money back. So you pay tax on it. Right? It is deemed income under section 59. Right? It is similar to section 41 under the head PGBP. Okay? Right. And this applies even in case of succession and inheritance. Now, last topic of today, that is virtual digital asset. What is it? Basically cryptocurrency. Right? like you would have heard about Bitcoin, Solana, right? Even Donald Trump released the Bitcoin, sorry, his own coin. Even GeoCoin is released. All these type of currencies are called as virtual digital asset. It may be recorded in some information, code, token, or number, but it is basically virtual digital asset. Now, it is not Indian currency or foreign currency, right? Any legal tender of the government is not virtual digital asset. But this information, token, number, or code is created through cryptographic means and they promise value in exchange. They can be transferred from one person to other for consideration or even for free of cost. Okay. So in that type of situations, please remember it is virtual digital asset. Now, non-fungible token is one more concept. What is non-fungible token? It is a digital asset of your creative works. It's a digital asset of your creative work, right? Digitally, you try to protect your work. So it is non-fungible token. It is also virtual digital asset. And finally, if central government want to notify any other asset as virtual digital asset, then they can by notification in the official gazette. If central government want to delete something from the definition of virtual digital asset, they can do by notification in the official gazette. That's the central government's power. But if suppose this virtual digital asset, you earned some money out of it, right? You purchased some bitcoins, later on you sold, and you got more money. Then how it is taxed? Whatever your consideration you received minus what you invested, the difference is taxable, right? Difference is taxable. At what rate? 30% plus surcharge plus health and education cess at the rate 4%. Surcharge only if it is applicable will add. Okay. But sir, if suppose there is a loss in case of virtual digital asset, then that loss cannot be set off. Okay. Only if the consideration is there minus cost, balance is taxable income. It's taxed. If suppose cost is more, then you forget. Government also will not support. Basically, I don't support any cryptocurrency or any virtual digital asset. This is not government backed, so don't trust it for sure. Okay. With this, we completed the entire concept of other sources in the limited time possible, right? So, like the video, share this video with everybody. It takes some efforts. So, please support by giving some comments also in the description, right? Oh, sorry, in the comment box. Thank you so much. Bye, everybody.